I'm Darius McDermott, Managing Director of Fund Calibre, and I'm delighted to be joined by Deirdre Cooper, who's the co-manager of the Investec Global Environmental Fund. Deirdre, we see a lot of funds with different SRI and environment tags attached to them. Tell us what your definition of environment is.
So our strategy is really focused on investing in those companies whose products and services avoid carbon. Those companies who are going to benefit from this amazing structural growth opportunity that exists as we transition to a low carbon economy. So we've seen, different numbers come from different people. I think the most notable source is probably the UN IPCC, which is the Intergovernmental Panel on Climate Change. They think we need to invest globally about $2.4 trillion in the low carbon economy.
That's every year, you were telling us.
Every year. And we're currently investing less than a quarter of that. So if you think about, just generally speaking, you're investing in a group of equities that are selling into a very large market, and that market is growing very quickly. To the extent that you can pick companies with good competitive advantages, companies that generate good returns, then those companies have a really strong chance to outperform over the medium term as they benefit from this great structural growth tailwind.
Because I was going to ask you, it sounds, you might think there's quite a narrow universe. Tell us a little bit more about the investment opportunity and that universe of companies from which you can pick.
That's exactly right. So many people hear the word decarbonisation and they think, oh, well, you must be investing in wind turbines and solar panels. Whereas, of course, when we think about what we need to do globally to transition to a low carbon economy, we absolutely need to green the grid. But we also need a much more robust grid with software and storage. We need to electrify. Electricity basically eats the world as we transition. Electricity takes market share from all other forms of energy. And that's not just cars, which we talk about a lot, but that's also heating, that's industrial processes. And then, of course, there's a huge role in decarbonisation for efficiency. Not just energy efficiency, but resource efficiency, because everything we use has a footprint. So if we can use less of it, then effectively we're avoiding carbon. So we end up with a very large universe of about 700 companies, 6.5 trillion of market cap, very widely distributed around the world across many different sectors, ranging from defensive sectors like utilities to more high growth tech sectors.
And you touched on that figure of, I think it's $2.6 trillion of investment per annum. Maybe just for our viewers, how might you quantum that? What other sort of things might you be able to compare that to so they can go, that is actually a huge sum of money, or it's actually a quantifiable sum?
So that's a great question. And one way to think about it is globally, investment in fossil fuels is about 1.6 trillion every year. Investment in renewable energy today is about 300 billion. And then on top of that, we have investment in EV and other low carbon sectors. But effectively where we are today is if we just took all that money that's being invested in coal mines and offshore oil drilling and shale gas and moved it towards the low carbon economy, we'd be the vast majority of the way there. And this is a transition that we're seeing happening today. This is in action. You're starting to even see oil majors talk about how we need to cut capex. In E&P, we need to move it towards renewable energy. You're seeing policymakers insist that change happens. You're seeing consumers not wanting to buy electric cars, not wanting to buy combustion engines, but rather wanting to buy electric cars.
Another thing I thought was interesting was actually within your wider global team are several members of the Investec Energy and sort of mining and materials team. How do you work with them? How do we round that sort of square peg in a round box, so to speak? You wouldn't see those as natural bedfellows.
So we really believe that that's the right place for this strategy to sit. Effectively, that to invest in the energy transition, you need to understand energy. People who follow this sector as long as I have, I've been doing this for almost 15 years, will know that in the early days of this sector, we had a lot of companies that really didn't outperform. We had a lot of European solar companies, that many of which went bankrupt. And one of the key things to understand companies in this sector, I think, are to understand commodity markets, to understand regulation. All of those things, our energy team has deep expertise. If we think about the electric car piece of the sector, you mentioned metals and mining expertise. I don't think you could realistically build a proper electric car supply and demand model if you didn't have someone who really knew about lithium and cobalt and nickel, which are the key raw materials that need to go into those electric cars.
And just with respect to the carbon part of the process, because it's obviously a very complicated and well thought out process, but just try and sort of tell, again, the viewers in as gentle terms as we can manage about that carbon part of the process, because I think that's really interesting and differentiator of your fund to many others.
Oh, well, thank you for that. So what we do is we screen global equities. We start with all the equities around the world, and we find those companies who are exposed to this transition, who are in sectors like we talked about, the greening of the grid, electrification, efficiency. But then on top of that, we apply this screen for carbon avoided, which I think is quite unique to the way that we look at this.
I think it is, yeah.
And what we're doing is we're looking to see, are your products avoiding carbon relative to the baseline today? So if you're a utility, if you own power generation, is the power generation you own cleaner than the grid in which it sits? If you're a car company and you're selling cars, are the models you sell more energy efficient than the baseline? If you're down the value chain, are you selling into cars? If you're a semiconductor company selling into cars, are you selling more into electric cars or more into combustion engines? And putting together this screen was a process that we worked on for about 6 months. We spent a lot of time looking at academic data, looking at reported data, mapping companies in developed markets that report to their peers in emerging markets that don't, and developing this universe screen. And ultimately what it gives you is a universe that should automatically respond to the extent that we ever had, for example, a global high carbon price. If we waved a magic wand and somebody said tomorrow that carbon is going to be priced at $80, all of these companies will automatically outperform because their products and services avoid carbon. Personally, I think that's unlikely, but I think that global high carbon price is a great proxy for environmental regulation moving at different paces in different countries and different sectors around the world, but ultimately moving in the direction of decarbonisation, promoting lower carbon technologies.
And finally, I think another part of your fund and process, which is of real interest and differentiator, is the fact that you only invest in 25 stocks. Would you just explain why it is that your fund has such a good concentration of investments?
Sure. And we spent a lot of time thinking about the best way to invest in this sector. As I said, I've been doing it for almost 15 years, ran for 10 years a managed account for the world's largest sovereign fund in this sector. And ultimately what we felt was that for both alpha and impact, which are the two things we're trying to do with this portfolio, a concentrated portfolio is the right way to invest in this sector. This is a disruptive structural growth trend. You need to be in those kind of sectors. Think about the early days of the tech sector. You need to be in the best-in-class companies, the long-term winners. And from an impact perspective, of course, if you're investing in listed equities, that's secondary capital, it's not primary capital. So your impact is predominantly through engagement. We think that PM-led engagement is much more powerful. You build a relationship with these management teams over many years, and that's a relationship that you can't really build with 100 companies in a very high turnover portfolio. You need to be concentrated. We typically meet management 4 or 5 times a year for the companies in which we invest. And then, while we would not want to overestimate our ability to influence, we think it's certainly stronger than if it was a more diversified portfolio, or if we relied on an external team to do our engagement for us.
Deirdre, thank you very much. That's been really, really interesting. For more information on the Investec Global Environment Fund, please visit fundcalibre.com.